It's so important to look at the economy for what it really is. Not a single synchronous situation, it's a bunch of separate moving parts, and each has their own strengths and weaknesses. Some areas will do well when crude oil is high and will do poorly when oil falls. Some areas are heavily dependent on the tech sector, others for tourism. But when nobody expects it, suddenly all assets fall. You came here for the truth, so let me unveil that for you. Today we are going to look at several economic indicators. I'll show you charts, I'm going to show you articles. Let's begin by taking a look at this chart. Non-financial corporate debt to GDP ratio. I've shown you this before, and you can see that we are again repeating history. Look at this. In all these previous cases, when you had the corporate debt to GDP ratio hitting a certain level, we have a recession that follows. Whether it's the financial crisis, you could see what happened there, the dot-com boom and bust, and all previous instances. They hit a peak and they fall. Does that necessarily mean that where we are today is going to result in a crash tomorrow? No. But when we look at the rear view mirror, we're going to be able to plot this and understand that, yes, again, we repeat the same patterns. The same events keep occurring over and over again. The reason for the crash may be different, but it doesn't matter when you think of, your pocketbook. You need to worry about your money, your family, and your savings and everything else. That's all that really matters. Protecting that is key. Looking at this here. Non-financial corporate liability and assets, and the GVA, which is the gross value added. So when this ratio here gets to a certain peak, we have a recession that follows. It's the same thing happening all the time. I've shown you literally hundreds of indicators now, which have brought us back to either the financial crisis level, the dot-com boom and bust level, or in some cases back to 1929 levels. Looking at this here shows us how high and how far we've come in this particular instance. But to me, when I look at this, it doesn't really matter. I don't really care about non-financial corporate liabilities and assets. I don't care about any of these indicators specifically. But what I do care about is encountering the same issues which we've had before. There have been countless recessions in history. There will be countless more in the future. What I want to be is on the right side of everything when it happens. I'd rather be 10 years too early than 1 minute too late. But that's just me. Many people have no idea when to sell, and that's a whole other issue. Cycle peak, high yield relative valuation nears worrisome levels notched in 97 and 2007. This is the US junk yield to worst US high grade. And looking at these, I'll show you, by the way, what this means in a minute. You can see the previous two instances, and here we are today. This right here is, again, bottoming out. Whether it's going to continue to get worse, we may see that, and where it will go from there. We're going to have to basically plot that out in the pages of history. So this really it's being broken down here in this article out of Bloomberg. Students of history will find two parallels of today's credit market, and neither will provide much comfort. According to a key valuation metric, investors are headed for the kind of bullishness on high-yield bonds that's been seen just twice before. During the halcyon days of 97's tech bubble, before the Asia crash, and on the eve of the global financial crisis a decade later. The ratio between the U.S. junk bond yields and their high-grade counterparts has reached levels that harken back to the high-risk appetite days of October 97 and June 2007. It's not a great set of dates along the credit market timeline of overconfidence. We have a big problem on our hands, and this is not being addressed, but it needs to be. It really does. It's hard to recall. By the way, this article right here is out of Bloomberg, and it is nothing but a propaganda piece to ensure some confidence, put some confidence back into Deutsche Bank. I've been covering the problems about this company now, and this entire article talks about why everything is just fine. It's hard to recall the last time there was good news of Deutsche Bank. Record fines, criminal charges, restructuring plans, layoffs, write-offs that don't seem to work. Loss of senior management infighting, credit rating downgrades, and new lows for the stock price added to the U.S. list of troubled lenders. Only three of the 33 equity analysts following the German lender are positive on the stock. And essentially what it's saying here is that Deutsche Bank, let me just highlight this for you here. Deutsche Bank is no Lehman. And the article talks about how you don't have to worry about the next Lehman crisis coming from Deutsche Bank. They are a solid company. They have lots of money sitting there, and their issues are so small compared to Lehman. It's a big company. You don't have to worry. And that's, as far as I'm concerned, propaganda. And the reason I say that is because the company doesn't need to be small or big. It just needs to start the dominoes falling. Even if it's not Deutsche Bank, who owns Deutsche Bank? What other companies are intertwined in Deutsche Bank? That's the reason I bring this up with any company, with any country. Who owns each other's debt? Who is dealing with who? Who's going to lose out? Think about the CDS. If you take a CDS out on a particular company, what if that company can't pay out in the end? Did we not learn anything from the housing crisis? The global economy is growing and corporate defaults are low and projected to drop even further. Yet the Wall Street investment bankers who feast during recessions are optimistic about their business, and some say it's starting to feel just like it did before the financial crisis. This article goes on basically talking about the issues that have seemed like we're heading back into 2007. And I do agree based on so many factors. And I've shown you that here in this video today. But it's now other businesses suggesting the same thing. U.S. monthly auto payments reached record high in the first quarter. The average size of a loan for a new car or truck in the U.S. set a record in the first quarter, as did the average monthly payment. Consumers are lengthening loan terms, with 6 years being the most common. 6 years to pay off a car is really a long time. There was a time when you wouldn't finance a car. People would pay in cash. People would have, a few installments. Now, today, people are taking 6 years to pay off their car, and that's the most common. Remember that. Outstanding loan balances reached a record high of $1.1 trillion. Loans for used vehicles reached $19,500. So basically $20,000. That's also a record. So we have a big problem. Over $1 trillion in outstanding loan balances. We have used vehicles, the loans on those hitting record highs, $20,000. And the fact that people are taking 6 years to pay off their cars. They're stretching it out as long as they possibly can. Now, could potentially people be more frugal? They can keep a car for longer. Maybe they don't need a car. They could take mass transit. Maybe they have other issues of too much debt in their credit cards and their student loans. I get all that. But I look at it for what it is. And that is, there's too much debt right now. People are pushed to the edge. But why worry? That's the issue. Why worry? I mean, look, you only live once, right? That's why we should just rejoice. The second biggest ever week for tech fund inflows. That's it. Buy your FANG stocks today. You want to be rich? Buy your FANG stocks. That's it. That's all you need. 7 shares of Facebook, 7 shares of Amazon, 7 shares of Netflix, and 7 shares of Google, and that spells rich. The FANG stocks will make you rich. rich. Did I say that? All right. This article here out of Bloomberg, it's a Bloomberg day today, is talking about oil and the areas where we have a lot of oil output and the jobs then obviously focused around the oil industry. Then you have other things like transportation and restaurants and hotels and construction and materials that need to happen and all the people involved in real estate and everything else. Well, in the areas that have seen a boom in oil recently, they've been doing very well. In fact, the unemployment has dropped significantly, and this right here is talking about an actual labor shortage. Shale country dangles 100% pay raises as the labor market runs dry. Interesting. So certain areas doing well for certain things, other areas not well at all. The labor shortage is inflamed by the real estate market. The supply of homes for the sale is the lowest on record. Crazy to think about all this. Actually, a similar issue happened in the tar sands in Canada as well. Hasn't recovered, unfortunately. And then I want to leave you with this. I'm not going to even talk about it, in fact, because I got halfway through the article and I had to stop. You can see the picture for yourself. It's about Venezuela. It just, I can't even talk about it. It's, I think you should at least skim through the first part of it just to see for yourself what's going on there. That's all. I'll end the video. If you found it informative, please give me a thumbs up. Now, if you want the financial education that was not taught to you in school on purpose, you can learn from me. And what I've done is squeezed in all of the education that I have been accumulating over the years into 2 books. These 2 books right here are $30 in total. $20 for my first book, $10 for the second book. And for $30, you get more education than you will have in an entire, you go from kindergarten all the way to grade 12 and on to post-secondary education potentially. You went through all of that. You didn't learn a single damn thing about your financial education. Right here for $30, you get that. So I hope you do appreciate it. I know that many have been coming to me telling me how much they've learned, how much they appreciate my books, and I really do. I just want to extend my thank you to all of you for sharing that with me. It's important because I wrote the book initially, if you know my stories, part of this, I wrote the book not to go out there and sell it. I actually wrote the book initially for family and friends. They didn't really give a damn, so it ended up on Amazon. But anyway, if you don't like reading too much and you want the audiobook, I noticed a bunch of people have been buying the audiobooks recently. It's only available on my newer book, Global Economic Collapse. The financial education is, from the Money GPS. It's so much more in depth with charts and diagrams and everything. I couldn't do the audiobook version for that one. But if you want that, it's on themoneygps.com. If you want the links in the description below, take care.